welcome. You're listening to the Best of Investing on News Talk 910. You know our show. It's where we present valuable information about real estate, the financial markets, and other economic business of the day. And for those of you listening for the first time, here's our format. There's a few guys sitting around a bar having drinks without the drinks, talking business with you, the audience listening in. I'm your host, Edward Brown, and I'm pleased to have as my co-host Mark Hanf of Pacific Private Money, California's fastest growing private lender, and Robert Spinoza of RPM Mortgage. Our phone number is 888-912-1190. Write that number down, 888-912-1190, because you're going to use that number to answer the trivia questions for 3 vacations given away during each commercial break. You got it. We're giving away 9 vacations during this show. Vacations are sponsored by Lighthouse Resort and Marina, located 1 hour northeast of San Francisco. Vacations are free. Their only request, a $75 cleaning fee to cover housekeeping expenses. Their website is lighthouse4fun.com. You can reach them at 916-777-5511. And today's trivia theme is Indiana Jones movies.
Oh,
you guys like that? You're going to be good? Okay, you probably will. Our website is bestofinvesting.com. Check us out on Facebook and check the like page because you like us. And we're also
really like us.
That's right. And if you YouTube, type of Best of Investing radio show. We're also on television, Comcast Channel 26 on Saturdays at noon and Sundays at 6 p.m. Now, Robert, I think we need a plumber because you've got something about cash leaking out of 401ks.
We're talking about leaks today, huh?
All right.
Go ahead.
I found an article that I thought was fascinating, and it ties directly into what I see day in and day out in my profession. I'm a home loan professional, so people looking to buy homes, and next question is where they're going to come up with their down payment. So I believe it was on Business and Money, cash leaking out of 401k plans at alarming rate. So I think we all have something we can contribute on this because we all see it from a different angle.
Absolutely. Well, what was interesting about the article to me is it says 1 in 4 American workers with a 401k tap their retirement accounts for current expenses.
Right. That alarmed me too. I didn't realize it was that high.
It's just it says in 2010. I'm curious to what it would be in 11 and 12, but they only have numbers for 2010. It was $70 billion in 2010, and they're talking about how the 3 ways that people are tapping their 401k. The 3 basic ways. One of course would be hardship withdrawals. The other one would be loans that people are taking out, like maybe to buy other assets, thinking they're going to pay it back, but not. And then the third one was cash outs when workers switch their jobs. But
I wonder if that helps the economy, though, right? You take money out of your 401k and you spend it on a boat or some other expense or helping
for
out
a while.
For a while, until that money runs out, and then they become a burden on the
and then
society.
they retire.
Yeah.
Well, I've been talking about this for actually several years because in my company, Pacific Private Money, we make privately funded loans, and the source of our money are from people's savings and retirement accounts. And so, one of the things I've attended a number of events, for example, self-directed IRA events where people talk about the statistics of how most Americans are just not on track to retire successfully.
Right.
They're just not only they're either one of 2 things or both. They're not saving enough in their retirement accounts, or the savings they have in their retirement accounts are not earning a high. It's not earning a high enough yield.
Right.
The last 10 years we've had so with super low interest rates, which is why my particular investment option that I provide for my clients, which are trust deed secured notes,
right.
Earning 8% and more, are so popular right now because, quite frankly, people have to grow their retirement accounts at a rate that will allow their savings to grow over time, so they can not be in a position where they're having to have Alpo for dinner.
One thing with Alpo, I haven't heard that. One thing we talk about a lot in our industry, a word we use frequently is unprecedented, because in the last few years, unprecedented rate lows, unprecedented. You will not see these again. I think one of the interesting components of that is a lot of financial advisors and planners and people who offer projections have not considered unprecedented over an extended period of time with these ramifications. In other words, if you were looking at the Social Security Fund, or you were a financial advisor advising someone 15, 20 years ago, you would be saying, well, what's an average rate of return? It would not factor in where rates have been over this period of time. Almost last decade. I think that's another part of this.
Well, the other thing is that what is this unprecedented stuff that's happened going to look like in the future? How does it
Right.
affect future generations?
Right.
That sort of thing.
Well, Robert, you said something earlier before we went on the air about because you're a mortgage loan professional and you work with home buyers,
Right.
and you're seeing some interesting phenomena happening in the industry with respect to where people are coming up with their down payment.
Right, and that's always a good indicator because you're going to see buyers come in all shapes and sizes, and some of them are going to have their down payment be a gift, okay, or a large part of it will be a gift. You're also going to see some buyers come in with proceeds from a previous sale. Okay, these are organic ways that are common. Obviously, their own savings.
Well, and let me ask you a very quick question on that with the gift.
Right.
I know that in the past, banks really didn't like to see that
Yeah.
they were gifts. So is it still the same way with buying a house?
No, I mean, gift funds are permissible on many programs, but they need to be qualified. And for example, lenders view them differently. There are some programs that require a minimum borrower contribution, 3 to 5%, even if the gift is 20% or more of what they're going to buy. So you have to look at. Gone are the days, Edward, where money just poof appears in an account, and that's not going to fly.
Yeah, no, because I know that they ask for bank statements, they ask for deposits. And
Exactly, and a legitimate gift is going to entail that there's a donor that states on the letter that they expect no repayment, and so yes, you have to qualify the gift. But what I was going to say is that when you have absent the gift, absent savings, then we are seeing more people reach into their 401ks and pull those funds out and apply them to the purchase of a home.
Yeah, because you were making a point that it's not as common anymore today when people buy a house that they have $100,000 or $200,000 for a Bay Area home purchase saved up.
Right.
It's either, like you said, it's oftentimes a gift or sale proceeds if they were lucky to have a house that actually had equity in it.
But that's a good point.
Or going into the 401k and borrowing it, which is really dangerous if you don't have a clear exit strategy for how to repay that loan, because that's your retirement.
Well, not only that, but the taxes and penalties for not paying it back if you're under 59 and a half.
Right.
I mean, that's just a snowball of bad effects on that.
And in a hot market, which we've been fortunate in many ways to have experienced in 2012, you'd be surprised, I think, to know that the number or the attitude of buyers who will just say, well, 10% plus, the taxes on top of the money they take out.
Yeah.
It's a cost of doing business because what is the alternative?
Expensive.
It's a very expensive alternative.
Well, here it says in this article that penalized 401k withdrawals nearly doubled from 2004 to 2010. It went from 36 billion to 60 billion. So that's, I guess it's a little bit of a boon for tax income for the government, but it's really bad news for the graying of America. I mean, you're looking ahead 10, 20, 30, 40 years. What is our standard of living going to look like if people don't have retirement funds to support
Well, and
themselves?
here's the other thing: is for those people who are under 59 and a half, and the 10% penalty is a lot, and plus what's the 2.5% franchise tax board, but they may not have to pay a lot of income taxes if the reason they need their money is because they're not making a lot of money, right?
So simply because of the tax bracket?
Exactly, yeah. I mean, maybe they were, they owned, let's say, a restaurant and lost a lot of money, and that's the reason why they needed the money to repay stuff.
Okay.
And so that'll offset, so they'll have, let's say $1,000 to pay on taxes on 1,000.
Well, the other thing too is that it is a quantifiable amount of money they have access to. So if they've got 100K and they're going to lose 10% of that, then they can get their head around that and say, this is what it's going to take for me to get that 90K.
Well, here's the other thing: what happens if they had it in some investment that was going down, and they just say, I'm losing it anyway. I might as well just cash out. Guys, stay with us. We're going to cut to our first commercial break here, and the theme is Indiana Jones movies.
Yes.
All right, Mark's favorite. That's one of my favorites, Joe.
You can cue up that theme music. Everybody likes that.
There we go. Okay, what does Indiana Jones have a fear of? The first three callers with the correct answer, we're going to win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouseforfun.com. I saw Mark do a double pump there, so he knows the answer.
To that question.
Call 888-912-1190. That's 888. Don't give away anything, Mark. 888-912-1190 to answer this question. What does Indiana Jones have a fear of? Kind of a fearless guy, except he has one fear. 888-912-1190. Make sure to include your name, your email address, and speak slowly and spell out your information for us one letter at a time, and we will be right back. Okay.
So we can go into the rip up retirement plans a little bit next and talk a little bit more about that. Maybe get into some talk about what's the
75% of those who cash out their entire balance do so because of basic money management problems.
That makes sense.
It's funny, there's that guy, what the hell's his name now? That just was on the tip of my tongue, that writes, he's one of those gurus about, having the millionaire mindset, was the name of the book that he wrote. I read it, and I wondered, how true he was, but a lot of people talk about that most Americans just don't have a mindset for saving. They just, no matter how much money they make, they just find a way to spend it. And it's that lack of a millionaire mindset of how to, earn enough money so that you can save.
I do see quite a bit of that. I would support that. I see a lot of borrowers earning $200,000, $300,000, $400,000 who savings relative to that income is
Pathetic.
Substantially.
Well, I'm thinking of
Notably
myself
small.
because I've last couple of years I've done quite well with my little company, but that doesn't help that I'm paying off some little tax bills. So I guess that's
Otherwise,
kind
that
of
would
like a
be your
forced
savings,
savings. Yeah,
yeah.
right. But
Yeah.
it's hard to save. I tell you.
Okay, ready? Yeah, I know. Hold on a second. Okay. Welcome back to The Best of Investing. I'm Edward Brown, your host, and along with my co-host Mark Hanf of Pacific Private Money and Robert Spinoza of RPM Mortgage. When we cut to the first commercial break, we asked this trivia question. What does Indiana Jones have a fear of? And Mark Hanf, I think he knows the answer.
Snakes.
Snakes.
That's right.
That is correct.
Yeah.
Very good. Robert, continue on with this article because there's some interesting things about the 401k. I think, let me just interrupt for a second here, or start off. One of the things we were talking about before was, people cashing in their 401ks.
Right.
If they have money, let's say they could have had money in, let's say, the stock market that was doing poorly, now is doing better. But if it's just sitting in a money market account or a bank CD and they're earning 0.0001%.
And there's a lot of people doing that because of the shell shock of 2008.
Yeah, so
I mean,
they're
I was
looking at it
one of
going,
them.
they're looking at this not growing, and
Right.
maybe they're thinking, you know what, I might as well use the money for something.
Dow at 14K, we're just talking about that now, and you're looking at, okay, I missed this run up, and
Yeah.
so
Or Obama's going to take care of all of us, so they don't need their Social
That's
Security
right.
tax
The nanny
anymore.
state.
The
Yeah.
what?
The nanny
The
state.
nanny state,
The
yes.
nanny state we're
Yes.
heading towards. So we started talking about this article, cash leaking out of 401k plans at an alarming rate, and that was in an article just this past week from Time. And in Friday's Wall Street Journal, interestingly enough, there was an article that is a little bit different but related, I think. I think there's a correlation, and it's titled Americans Rip Up Retirement Plans. And what it goes on to say is that nearly 2/3 of Americans between the ages of 45 and 60 say they plan to delay retirement. Well, I don't think that's really news, but what's news is there's apparently been a steep jump from just the last 2 years as they've tracked these statistics, and they found that there's like a 42% jump of people who have now said, well, they plan to delay retirement, and the reason for it is the increase in financial losses, layoffs, and income stagnation.
And they want to pay, and they want to spend their kids' inheritance.
That's a whole different story. But
That's true, because if we're talking retirement, they have to actually live off their retirement.
But if you don't have a sufficiently large enough retirement savings, whether it's in a 401k or a Roth IRA or a traditional IRA, or if that IRA is not growing sufficiently and you're looking ahead, you really do have to change your plans. And so I know for myself, what retirement? I'm not looking ahead going, oh yeah, well 65, I'm going to retire.
Well, no, didn't they also change the age to for Social Security? Right, the minimum age is like what, 70.
Well, that's one of the tricks that the government is
Makes
employing to
tricks.
try to, save Social Security, which again was a whole different issue that we can, spend a whole show talking
Well, we
about.
were just talking about that before the show, and how there are some economists that look at the opposite side of that and say they should be lowering it because that will force people to go into retirement earlier and free up the workforce.
Yeah, but I
maybe?
totally disagree with that because first of all, Social Security, it doesn't give you enough money for those
Right.
people to retire, so they're going to work anyway. So I predicted
It's not an incentive to retire.
It's not an incentive.
Right.
Now, 30-something years ago, I predicted that they were going to tax Social Security, and
Uh-huh.
it was true. And my next prediction is that they're going to tax. They only tax part of it.
Right.
Next thing is they're going to tax all of it, and they're going to say if you, Mike, this is just a prediction on my part. My crystal ball says.
Well, it's a
at
radio
some-
show. I mean,
Yeah, that's true. You don't even
You're
want
the
to say
bully
anything you
pulpit
want.
here.
That's right. My prediction is, and again, I hope Congress is not listening, but
Oh, I don't think they're listening to anybody.
yeah, that's a very good point. But my prediction is that they are going to say if you have other assets,
Right.
you're going to have to qualify for Social Security.
So a means test.
Yeah, exactly.
Basically.
Even though technically I've been putting money in all this time from.
Yeah, no, but I've got to say that some of the files that come across my desk, and maybe it's a bias based on the financial education upbringing I had, but when you see a borrower who earns $300,000 or $400,000 a year collecting Social Security, it makes you sting a little bit because you look at it and you say this guy doesn't need that money, but
he put the money.
He put
in.
that money in there.
But then you go back again.
I
and
know.
Say, and I've mentioned this before in the show. I had a client who, her husband died in 1961.
Mhm.
So he probably put in for 20 years,
Right.
Maybe $2,000 into the system.
Right.
She was collecting about $1,200 a month,
Right.
and by the time that she passed on, when she was 101. So she collected Social Security for over 40 years. I mean, that was a great investment.
Right.
But it's so
Centenarians. I just was talking to a
that's a
an elder
good-
care person, one of the, I believe, the fastest
It is.
growing demographic.
Yeah, we got to figure. The baby. Well, no, actually, that's before the baby boomers.
Yeah, before,
So
yeah.
what'll happen is the baby boomers, if they're going to live
Right.
a long time, that's really going to be a lot of century.
Yeah, I think there's a lot of implications of the Social Security argument, and I think they tie into this. And one of the reasons why it's a great conversation is because of all the ways it does it, and with people's individual retirement accounts and plans. When you talk to financial advisors, I deal with them day in and day out, and they'll tell you the look on people's faces when they say, "This is what you need in order to produce an income stream to be consistent with your lifestyle in retirement."
Well, especially what kind of interest rate are they going to earn on that? And, I wouldn't mind if the government were to change the Social Security system to where they said, a forced savings.
Right.
Which, I mean, in a sense, Social Security is, right? Because they're forcing it out of your paycheck.
Right.
Right.
The only problem is that, they determine who gets it and who doesn't.
Right.
Because there's definitely a lot of people who get it, who may not, we would all look at the judgmental attitude that we
Right.
have and say, wait a minute, this guy is on the streets and why is he getting Social Security?
Right.
That sort of thing. But a forced savings, that might help supplement people's income, sure.
So getting back to this article, there was this was based on a study of 15,000 individuals in 2012, where they found a significant jump in the people who say they're going to work longer. And I normally like Wall Street Journal articles, but I was a little bit caught and surprised by this quote from the co-author of the report. He said, "The stark increase in workers expecting to stay on the job, now at 62%, was a surprise to him." And he went on to say, after all, the stock market has largely earned back its losses, home prices are rising, and the unemployment rate is creeping down, all of which suggests workers should be feeling more secure. Now,
Makes sense to me.
I'm sorry, but that's probably the dumbest thing I've read
Sure.
Oh,
in a
now it
respectable
doesn't make sense to me
financial
anymore.
no, a respectable financial journal. And here's why. Look, it's 2013, right?
Yep.
Right.
I'm about back nearly to where I was maybe in 2003.
For the stock market.
Right.
Or just
Or
what-
just my-
In general. Right.
In general, in my personal financial,
Yeah, but forget about the last 10 years. You got to look from today going
well,
forward.
that's the whole point.
That's the whole
is
point
that
of it, right.
is that in my life, and I know a lot of people listening out there, the last 10 years is the lost decade.
Correct.
Some people are not even anywhere near back to where they were 10 years ago, let alone even or ahead.
Well, you take into that the herd mentality. How many people did you hear at the nadir in 2008 say, "I'm out"?
Got out of the stock
Right.
market and all that.
Yeah.
Oh, yeah, absolutely.
Did they get back in the next day? No, they're still out. Most of them are still out because they keep thinking the other shoe's going to drop.
Yeah.
Right. How many people have really enjoyed the fact that the Dow hit 14,000 on Friday, unless you were all in 2008 when it was at 7,500? So, geez, Louise, it's anyway, it's really crazy.
Looking backwards, so much of this is abundantly clear, but yeah, I mean, you have to look at people's real circumstances. And I think in our individual capacities, we see that all the time.
Mark, we're on radio. Can you say "Geez Louise"? I don't think the FCC will like that. No, I guess okay.
Now we got the FCC on our backs too.
For "Geez Louise."
Congress, FCC.
Anyway, guys, we're going to cut to another commercial break here. When we get back,
Jeez,
we're going to go
another commercial.
again with that.
Maybe we'll see you next week.
Yeah. You guys are just too much fun. So we're going to cut to another commercial break. When we come back, we're going to get into email time. And we have another special trivia contest here.
All right.
Okay, you ready for this one?
Yep.
Okay, this is the Wine Country Inn. So surrounded by vineyards and secluded up a country lane, the Wine Country Inn has evolved from the Napa Valley's very first bed and breakfast inn into a magnificent antique-filled boutique hotel. Their award-winning country inn, along with its proximity to many of Napa Valley's finest wineries and restaurants, makes the Wine Country Inn a perfect wine country vacation or weekend getaway. Call 888-465-4608 or go to winecountryin.com. Now, here are the rules. You cannot have won any contest on the Best of Investing. You can't be a previous winner.
No.
You have to email Edward at bestofinvesting.com by midnight tonight the answers, and then the following week, randomly, we'll choose the winner. And here's the special trivia contest. More than half of the people do this at the table while eating. Okay? We all know the rules. Now we're going to cut to the commercial break where the winner is going to receive a free 3-day, 2-night. The first 3 callers are going to win a free 3-day, 2-night stay at the Lighthouse Resort. So here's our commercial break. Question. What 2 weapons did Indiana Jones carry with him at all times? The first 3 callers with the correct answer to this question are going to win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-912-1190. That's 888-912-1190 to answer this question. Excuse me. What 2 weapons did Indiana carry with him at all times? Call 888-912-1190. Make sure to include your name, your email address, and remember to speak slowly and spell out your information for us 1 letter at a time. And don't touch that dial because we're going to be right back. Excuse me.
Yeah. What are the email cues today?
Oh, yes. The 2 emails we received from Mark.
I'm like Beyonce. I got to lip sync it, so I got to know.
That's right.
Here.
Oh,
Is that what happened?
I think it went up. I think everybody just said, "Oh,
No, she did admit to lip syncing at the inauguration. So she sang it live, like on a.
Okay, so it really was her. It just was not her at the time.
She said she sang it, but it was a track as well.
You know what?
Yeah.
Oh,
So what?
I know.
I mean, as long as it was not Milli Vanilli from another, they did sing someone else's thing, right? Or did they actually? They didn't do the track
They didn't do anything.
themselves. Yeah.
Yeah.
Okay.
Yeah, right.
just looked
They
the
didn't
part.
write
They
the
did- they
music
wrote the
and they
videos.
didn't sing the song.
It's
They just showed up. They were models.
sort of like the Partridge Family, or Johnny Bravo from the Brady
Johnny
Bunch.
Bravo from the Brady Bunch. That's right.
Remember that?
Johnny Bravo.
Okay, so let me tell you what emails we received for you 2 gentlemen. For Mark, it was, what happens if I invest in a deed of trust and need my money back before the loan comes due? Can you sell it for me? Okay. And Robert, it's, how come you're so good looking? No. I asked that of him one time. Yeah, he got that one once before. Okay, would you suggest an ARM or a fixed mortgage at this time?
Would you suggest an arm or a leg?
See if I can tie that one into that.
Do you remember when gas prices were going way up, like really quickly?
Oh, there was a sign.
So
Yeah,
it's an
arm,
arm,
leg.
leg. That was funny.
That's a topic for a whole other show.
Yeah, that's right.
Gas prices.
Yeah, what?
I don't hear anyone talking about it.
Because it's been kind of,
350.
yeah, and go
Until it hits 4, it goes over 4. People don't panic.
Right.
I still remember 25 cents a gallon. Okay, ready?
Yep.
Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hanf of Pacific Private Money and Robert Spinoza of RPM Mortgage. When we cut to the second commercial break, we asked this trivia question. What two weapons did Indiana Jones carry with him at all times?
I know one was a whip,
That's the one I got.
gun,
And the other one was a pistol.
pistol.
Yeah, do you remember that? He's in Raiders of the Lost Ark, and the guy comes out the samurai sword and all this real fancy
Oh,
stuff.
right.
And he pulls out the pistol and shoots him.
That's true. That's right.
Okay.
That's good.
Email. Mark Hanf, we received an email for you. It says, what happens if I invest in a deed of trust and need my money back before the loan comes due? Can you sell it for me? You have to explain what that question means.
Good question. So, and that was a good topic for today because we're talking about the fact that people are having a hard time growing their 401ks properly, and at Pacific Private Money we originate investment opportunities for our investor clients, and it's an alternative asset class. It's called alternative because it's not like a publicly traded stock. It's rather illiquid, but the benefits of the high returns you can earn on what's called a trust deed secured note, or sometimes referred to as trust deed investing, the returns are 8% or more, are so compelling that the lack of liquidity is not really an impediment for most people.
Yeah, but the lack of liquidity, we're not talking about 20-year investment.
Right, that's exactly it. It's not right. It's not like investing in a 20 or 30-year note. I mean, the loans we write are mostly short-term because we're writing loans to real estate investors who are willing to pay a high rate of interest for the use of money for a loan, and usually it's to buy fix and flip real estate. That's
For a
about
specific period of time.
About 75% of the hard money or private money, whichever you want to call it, they're both roughly the same, mean the same thing. About 75% of hard money loans written today are for the purpose of purchasing property for a short-term use,
And those
short-term
borrowers,
duration.
yeah, those borrowers don't want to pay a high rate of interest for a long time anyway.
Well, that's it. But they'll pay it for a short term, the 6 to 12, sometimes 24 months. Maybe they're collecting rental property and they've run out of bank loans because sometimes you can only qualify
Right.
for 4,
Yeah.
but they buy more, and so but they're still buying at such a good price that even a hard money loan at say 10% interest still makes sense because they believe that at some point in the near future, 1, 2, 3 years down the line, they will be able to get conventional financing that's less
Right.
expensive, and so again, it makes sense to borrow at that rate.
And it's a great deal for the investor because the borrower rehabber, so to speak, is improving the property.
Yeah, absolutely.
So your loan to value keeps going down. Your equity or
Right.
protection is going up. So that if the borrower doesn't pay, that's almost the best thing that can happen to your investor.
Well, absolutely. And so to go back to the question was, if I invest in a deed of trust, which is really a deed of trust secured note, and I need my money back, how would I do that? And the answer is that often it wouldn't be the first time it's happened in my company where someone has called and said, I really need my money back. Can you find someone to buy my position? And it's generally easy to do. And oftentimes, depending on the interest rate, if it's a high interest rate note, you do not have to take a discount. So if you funded a $100,000 note with $100,000 and the note rate's paying maybe 9% and you're receiving 8%, I could probably very easily find someone to invest in that note at $100,000. Now,
So they don't pay.
I might, well, I depending on
Okay.
the client and the relationship I have with the client, I will charge probably a nominal fee. How nominal depends on how much I like the
So
client.
it's sort of-
Fair. You know what, Mark? You're too honest. I'll tell you.
So that analogy is sort of like you go onto a car lot and you're looking to buy a new car and they sell you a certified pre-owned. That's what's happening with the other investor there. It's basically they were looking for an investment like that and you found one for them, but in a slightly unconventional.
Yeah, and the truth of the matter is there's actually a lot of money out there looking for quality high yield investments. So
Right.
if I all of a sudden go to my investor base and say, hey, I've got a $100,000 note that's been paying regularly for a year.
I was just going to say that a seasoned note is a lot better than a pre-owned type of car.
Sure.
Exactly. So again, there's a lot of variables, but you know, the easy answer to it is you know, generally speaking, we can get your money back, oftentimes all of your money back for a nominal fee. So it's even though it's considered an illiquid investment, there's demand for it.
And again, that nominal fee, that's really only if the person absolutely has to get their money back before the maturity of the loan.
Right.
If they want to just stick it out and just keep the loan to maturity for 6 months or a year, then there's no penalty.
And I'm sure that calculation can be done and reveal exactly what it needs to. So it's not like it's a mystery.
Right, it's not.
Yeah. Okay. Very good. Investors, how would investors get a hold of you?
So Pacific Private Money, we've got 2 websites if you're interested in trust deed investing as opposed to borrowing money at high interest rates. Our investors should go to pacificprivateinvestments.com. That's pacificprivateinvestments, plural.com, or call our office at 415-883-2150. That's 415-883-2150.
Or check out our Best of Investing website and see Mark's handsome face on that one.
Oh, yeah.
And Robert, we have an email here for you. It says, would you suggest an arm or a leg when you go to dinner? No, I'm just kidding. Would you suggest an arm or a fixed mortgage at this time?
You know, I'm a big fixed mortgage fan. I'll tell you why. We were talking earlier, unprecedented. We're sitting at unprecedented lows. I was talking with a financial advisor the other day, and he was saying that his take on this whole thing is if you can get 30-year fixed money at the rates you can get it today, where do you go from there? I mean, you're holding on to a note that's 30-year, probably in the 3% range.
And if you can get 15, if you can afford
15 would put you in the 2
quarters.
Right, put you in the 2%. So
incredible.
fixed rate money right now is just so attractive that for somebody to make a case to me for an ARM loan, it would have to be extremely compelling. They'd have to say, we just don't need the fixed years, we don't need the time, there's no eventuality that would carry us out beyond 5-7 years.
And what's the difference in how much were they going to
Yeah.
save? What's the interest rate?
Well, that depends on the program, and that's a great question. So, you know, that's part of the calculation. If they're saving 0.5%, let's do that math, play it out over the fixed years on the ARM loan, because most ARM loans technically are hybrid loans. They have a fixed period initially, and then convert to an ARM for the remainder of a 30-year term. So you can very easily take that savings times the number of months, and then propose that to the borrower and say, okay, what's really at stake here over 5 years is $9,000. How do you feel now?
The difference between fixed and variable rates years ago used to be significant.
Yeah.
How is the spread looking
Yeah,
today?
but you had so much room to work with, because if you were paying 8.5% on a 30-year fixed, maybe they'd give you a 5-year ARM at 5. Now you're dealing with a 3% spread. But I mean, where are you going to go? If you were at 3.5 on a 30-year fixed loan, maybe your 7 or 5-1 ARM will be in the mid-2s, possibly a point for giving away 25 or 23 fixed years. Most borrowers, and I don't fault them for it, but most borrowers close a fixed loan and you don't hear anything from them again. Most borrowers who close an ARM loan, every night they sleep, they think about what date that's going to convert to adjustable for better or worse.
That's a very good point, because you can't put a price tag on getting a good night's sleep.
Peace of mind.
Because and they're looking at the paper, they're looking at interest rates, and should I refinance again?
Right.
Should I lock it in at a fixed rate?
So the picture
Between your mattress and your home mortgage, get a good night's sleep.
That's the picture I'm going to paint for somebody who's doing that calculation. And one other thing to add to that, if somebody thinks that they're going to qualify with greater ease on a ARM loan because the rate is lower, talk to your mortgage professional, because oftentimes the qualifying rate is different than the actual rate.
Because the bank assumes the rates are going to go up. Because they have to prepare for it.
Yeah, I mean, you're not qualified. It's not 2005 anymore. You're not qualifying off the interest only at the start rate, which is what got a lot of people into
And how easy is to purchase money loan versus refinance with the fixed and on ARM? I mean, is it about the same kind of qualifications?
Yeah, it's about the same kind of qualifications, but I think the stats on that are I mean, it's tremendously in favor of fixed rate loans. When you look at the statistics for mortgage applications and what closes, right now, I think there's just such a small share of ARM loans.
Okay, and what kind of points generally are you looking at on jumbos? Because, some people can obviously do have loans that are not jumbos, but a lot of people I talk to, they have jumbos, which is what, over 640,
625, 500 here in the Bay Area.
Okay. And what kind of points are people looking at on fixed rate versus an ARM?
There's no set criteria, but when you look at the Freddie Mac index, they generally tend to include 0.7, 0.6, 0.7 of a point when they give you those average rates. But the majority of consumers that I work with will at least request a 0-point loan up front and then go from there. I think it's also helpful in your comparison to shop at zero across the board and then work your points in so that you understand what it's getting. If you go to one agency and you get a quote at zero and then another with a half and another with one, very quickly I found the end user gets extremely confused and it's not sure how to compare those two.
Yeah, that makes a lot of sense. Start at, what's your rate at zero,
Right.
and then what we're talking about when you say then go over points in there, we're talking about buying down your rate. So you pay points to buy down your rate.
Right.
That's the whole
Right.
reason.
And Robert, how do people get a hold of you if they have more questions about ARMs or fixed mortgage?
Absolutely. Anytime you can reach me at 877-270-5959. I'm with RPM Mortgage. I also want to just say that I am holding a home buyer webinar on February 5th, and it's absolutely free, and you can find the URL for that on Facebook at Home Finance Fundamentals. So Home Finance Fundamentals on Facebook. I'll post a link there. Join us, and I'd be happy to go over any of your questions about buying a home.
Excellent.
Yeah.
Very good. Here is our third commercial break. Final trivia question. Again, the theme is Indiana Jones movies. Finish this famous line. Throw me the whip and I'll throw you what? The first three callers with the correct answer are going to win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-912-1190. That's 888-912-1190 to answer this question. Finish this famous line. Throw me the whip and I'll throw you what? Make sure to include your name, email address, and remember to speak slowly and spell out your information for us one letter at a time. And don't touch that dial because we're going to be right back. Excellent. You know the answer to that one?
I don't know the answer to that.
I'm trying to remember what it was he was holding. It was the
pistol. You changed the whip for the pistol. No.
No, it wasn't a pistol. It was was it the first one or the
first one?
It was the first one.
I remember that time as a kid going into the movie theaters and seeing those movies. The second was it? No, it wasn't the second. It was the third Star Wars movie.
Oh, it's first. Return of the Jedi.
Return of the Jedi, and it was Indiana Jones, and they came like just one after the other. What a great time to be a kid seeing those movies.
Wait a minute, how old are you?
42. I was born in 70.
Okay.
So that was all like
early
early 80s.
one, yeah.
Yeah.
Oh yeah, that was a good time for you.
Yeah, it was. I mean,
I was already an adult. Me and Mark were the old guys.
Mm-hmm.
He's the old man because he's a
you
month
guys
older
can't be
than me.
what, late 40s?
I just
52.
turned 53.
53.
Oh, really?
Yeah.
That's right.
both look younger for 53.
Thank you. See, hard money loans it's not stressful
Yeah,
at
it's not stressful at all.
So I don't have to borrow at those rates.
So this morning there's a landscape contractor out at there's a landscape contractor out in my backyard working on the backyard, and he orders these pavers, and we did part of it, and now he's got to finish the thing, and they don't make the same paver anymore. So he comes out and he's pulling out these pieces, and he's like, I can still get it to work. I just got to move these around, whatever. And I'm like, your business is like mine. Nothing's ever easy. It's like there's always something that comes up. And so he starts saying, you got this other job where the guy wants him to put in these concrete posts. It's a lot.
Yeah.
So he goes, yeah, sure, I can do that. It's not a problem. He gets out there. There's no water. How's he going to mix the concrete?
Spray bottle.
He's like, so we were laughing. It's like, always something, right?
Yeah.
I mean,
Or you're going to a place and there's no electricity and you need power
Right,
tools.
right. And things you don't think of.
Yeah,
you know,
that's
it's
a
like,
great point.
How many minutes we got?
So I'm figuring it out here.
Fine. All right.
Okay.
What do you got?
What do we want to get into here? Let's see.
I got a question for Robert we can go into
Okay.
just as we're kind of wrapping up our mortgage. And then did you have something in there? I think?
Well, I did have this underwater home thing about Freddie and Franny walking away from it. That's kind of interesting.
Okay, let's get into that.
There was something about the hard. You probably didn't get a chance to look at the hard money loan things.
Oh,
I didn't see
no,
that.
I didn't.
It just talked about how there's Wall Street's getting into this because there's so much money to be made.
Well, Wall Street's got the whole jumbo market now. I mean, Wall Street's buying all the notes above 625.5. I mean, that's all Wall Street money.
Yeah, I was thinking more in the hard money loan business. But we don't have to cover it for this show, Mark.
Okay. Yeah, I'll study it.
That'd be a great topic for a future show. I'd love talking about
Yeah,
this stuff.
it's
It ties into
it's very interesting actually. Okay. Okay, so we'll go right into it.
Yeah.
Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hunt of Pacific Private Money and Robert Spinoza of RPM Mortgage. When we get to the third and final commercial break, we asked this trivia question. Finish this famous line. This is from Indiana Jones movie. Throw me the whip and I'll throw you
chocolate.
the chocolate. No.
I'm stumped.
Throw me the whip and I'll throw you the idol. Remember they were around the pit?
Yeah.
That's a very famous line. Okay, Mark, take it away.
So famous, I forgot. So I just wanted to ask actually Robert a question because we ended the last segment talking about mortgage loans and ARMs versus fixed rates, et cetera. And of course, anybody who's owns a home or who's gotten a loan in the last few years or recently knows that there's there's a huge shakeup in the mortgage loan origination, and a lot of mortgage brokers who were mortgage brokers 5 years ago are doing something different today.
Right.
And I'm curious because a couple shows ago we talked about how of all the loan originations that are going on right now, approximately 60% of those are refis. So, we're finally, and it's funny because we've had these wave of refis over the last 10 plus years as rates have trended down,
Right.
and each time we keep thinking, well, they can't possibly go any lower. So, assuming that maybe we've actually finally reached the bottom of the bottom and that we're not going to see another wave opportunities of rates in the ones versus the low threes that they are now. If that's the case, do you see another shakeup in the in the mortgage brokerage business? I mean, are we going to see a lot of out of work mortgage brokers in a year or two once this final wave of refinances is over?
Well, no doubt that many companies have staffed up in the last year. So you would have to assume that if there were any slowdown in business, one thing that we've all learned, having been through these cycles as you described, is that things happen quickly. And I think if the market shifts away from refinance business, there will certainly be fallout on the employment level at many banks. And it goes deeper than that, obviously, because all banks are basing their projections on where they think rates are going to go and what sort of volume we'll have. But 2012 was a record-setting year volume-wise, predominantly because of the refi business.
Well, it just concerns me because again, why should a consumer care? I mean, why are we even talking about this?
Right.
But I care as a consumer because I see my choices being limited when new laws are passed and the banks act in a way such that the independent mortgage broker is basically going the way of the buggy whip,
Right.
and that what it portends in the future is what I hate to see is we come to a point where the only option you have to get a bank loan is to go to a conventional loan is to go to your bank.
Yeah.
And I think that would really be a disservice because again, it's just fewer choices mean fewer options and higher prices. Yes.
Well, I think what you're really getting at is something that just transpired, and that's the definition of a qualified mortgage. We can maybe get into that on another show, but that's further restricting what Fannie and Freddie are accepting and recognizing as conforming now. So we'll see those go into effect in 2014. I will say that let's separate the interest rate difference between the credit availability difference, which largely we saw.
Well, it's funny you mentioned Freddie and Fannie because I saw an article here in Yahoo Finance. It says, soon you can flee your underwater home. I don't live in an underwater home, but they meant homes that don't have enough equity. There you go. but it'll cost you. So it says here, March 1 is going to be Liberation Day. That's when Freddie and Fannie are going to start allowing some homeowners who have been stuck in their homes to relinquish the houses and cancel their debt. So it's almost like a short sale without a real sale. Basically, it's what they call a deed in lieu of foreclosure.
So you turn the keys over and say, it's all yours now.
Yeah,
Thank
of course,
you very
what
much.
happens if there's a second and a third mortgage on there? The Fannie and Freddie are not going to take
That's right.
subject to that. And so there's certain rules here that you have to either be current or less than 90 days late on your mortgage. So all those people who are
serial delinquent.
It's serial delinquent people, they don't qualify. And homeowners must be making payments of at least 55% of their monthly income, and they must document a hardship. Of course, hardship by itself, 55% to me is pretty hard.
Well, if they got that loan in recent times, 55 would have been excessive of any debt ratio that would have qualified.
Yeah,
so it's probably a loss of job or something like that.
That's true.
Yeah.
Okay, and I love this. The home must be clean and not damaged. All right.
Trash.
Get this also. Homeowners may also have to surrender as much as 20% of personal assets, excluding retirement accounts. So that means you got to hand over some of your clothes.
I don't know.
And
Here's
put them
my
on
kids'
Craigslist.
bicycles and toys.
Right.
Yeah, exactly. It's so funny. I'm just thinking about why
That's
would
silly.
anybody do that? Why wouldn't they just, except for worrying about their credit rating? That's the only thing I can think of. Because otherwise, you just say, because there's no personal liability, right? It's non-recourse debt.
It is, and I think that there's just a core of people out there who have tried to do the right thing despite difficult circumstances, and this program may appeal to them. And I can't say anything bad about those folks. It's if it works and it gives them an out where they otherwise wouldn't have one, maybe it'll work. I don't know what market segment they hope to reach.
Well,
with
I
that.
remember there was a company that wanted to borrow a lot of money from us to buy a bunch of houses in Las Vegas. And at the time, it looked like a good deal.
Right.
Fortunately, we didn't do it. There was other reasons why. But they were telling us that there were times when they would go into houses where the people got actually foreclosed out, and the people were vacuuming the place.
Right.
I mean, there's just something about pride that they just didn't want to leave it a mess for someone else. That's good character.
I agree.
So I guess that program makes sense for people who didn't want that to impact their credit. So they've been making the payments on their underwater house because they had pride, didn't want to let that go.
Right.
The other thing is we talked about that too, is what if you get a job in another city?
Mobility.
And, now there's a mobility issue, and so that could certainly help people who need to move, need to sell their house, but aren't in a position because they're underwater. So that assuming they
Getting
have
on with your life is tremendous.
Well, when you do Freddie and Fannie, I mean, do they treat short sales as like regular banks do, or you can't do one with a Freddie? I mean, I don't understand.
In what capacity? When the borrower goes back into the market to try and buy again?
No. Let's say I own a home. I'm underwater,
right?
And I want to do a short sale,
right?
Where do Freddie and Fannie come in as compared to just let's say Bank of America loan?
Yeah, I mean, I couldn't. A realtor could probably give you a distinction on that as to what the attitude is when it's actually a loan serviced and the investor is Fannie or Freddie versus Bank of America or another servicer. Yeah, I'm not sure of the details on that.
Well, clearly that law will just aid in the number of short sales that are potentially on the market, because I think 2013 many people have predicted it to be the year of the short sale, and so this law that we just talked about Fannie Freddie allowing you to basically
but if you're current, a lot of banks wouldn't let you do a short sale.
Well, that is an interesting component of that, because if you are current and you don't have the other traditional elements to make you eligible for a short sale, maybe that is an out for those folks.
Well, it'll be interesting to see how that falls out. I mean, the point being is that the government still has not stopped trying to come up with new and novel ways to help the underwater homeowner, for better or worse. And government intervention is unfortunately a fact of life now, and in many ways, I think it actually has prevented that second wave of foreclosures we were all fearing, that tsunami of shadow inventory that we were all worried about.
Several years might happen.
Well, what I was going to say about that too, what's very interesting about this is maybe the government solved its problem in a way they hadn't envisioned, or maybe did, and that is you reduce the inventory so dramatically that prices rise up, and then that has a different starts a different cycle.
We live in a socialist society. All right, people. Thoughts for the day here. We're going to wrap this thing up. I just read that math illiteracy affects 8 out of every 5 people. That's terrible. And I love work. It fascinates me. I could sit and watch it for hours. Tune in next week to the Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.